Power of sales explode in 2026. Greedy speculators destroyed in Canada's housing crash. Across Canada's major cities, the signs of a deepening real estate downturn are hard to ignore. Properties once snapped up in bidding wars now linger on the market for months. Sale prices have slid backward, erasing gains that took years to build. And in a trend that underscores the pain, power of sale listings, where lenders step in to sell homes to recover unpaid mortgages, have climbed sharply. This mechanism, common in provinces like Ontario, allows banks to offload properties without full court proceedings, often at steep discounts. Data from recent months shows these forced sales making up a growing share of the market, reaching 2.5% of all listings in some areas by late 2025, up from negligible levels just a few years ago. This surge in power of sales points to a market under severe stress. Homeowners who stretched their finances to buy during the peak years now face mortgage renewals at rates far higher than their original deals. For many, monthly payments have jumped by hundreds of dollars. One estimate pegs the average increase at $576 per month for those renewing in 2026. When borrowers can't keep up, lenders initiate power of sale processes, flooding the market with discounted homes. In Ontario, where the bulk of these actions occur, reports indicate a parabolic rise in such listings since October 2025. Luxury properties, once symbols of speculative success, have sold for nearly half their previous values in some cases, with million-dollar homes liquidating at fire sale prices. At the same time, overall sales volumes have hit historic lows. The Canadian Real Estate Association, CREA, reported that national home sales totaled just 470,314 units in 2025, a 1.9% drop from the previous year. This marks the second consecutive year of declines, with December alone seeing a 2.7% month-over-month fall. In Toronto, sales reached a 25-year bottom at around 62,400 transactions, down 11.2% annually. Vancouver fared similarly, with 23,800 sales, the lowest in over 2 decades. These figures reflect a market where buyers hold back, waiting for clearer economic signals amid trade tensions with the United States and sluggish job growth. Prices, too, have taken a hit. The national benchmark home price fell to $660,300 by early 2026, down 4% year-over-year, and marking 7 straight months of declines. In Toronto, benchmark prices dropped 6.3% over 2025, slipping to $962,000 by year's end. Adjusted for inflation, national prices have reset to 2017 levels, wiping out nearly a decade of nominal gains in real terms. Greater Toronto area values are down 22% from their 2022 peak, while Vancouver and Calgary have seen similar corrections. Forecasts from organizations like CMHC and Royal LePage suggest prices could dip further in major centers through 2026, with Ontario expected to see continued declines before any recovery. This downturn arrives as no surprise to those who watched the market's rapid ascent in the late 2010s and early 2020s. What began as a response to low interest rates and population growth morphed into a speculative frenzy driven by greed and a lack of experience among many participants. Investors, drawn by tales of quick flips and endless appreciation, poured money into properties they could barely afford, often using home equity lines of credit (HELOCs) to leverage up. Canada's HELOC debt hit 12.89% of GDP by 2018, surpassing U.S. levels before the 2008 crash, and has only grown since. These loans, tied to variable rates, allowed buyers to treat homes like financial assets rather than shelter, inflating prices far beyond income growth. Unsophisticated players, everyday people lured by social media hype and fear of missing out, amplified the bubble. Many entered the market without understanding risks, assuming prices would always rise. Domestic speculators, including those holding multiple properties, accounted for up to 30% of purchases in hotspots like British Columbia and Ontario. They bid up values, creating a disconnect where home prices soared 375% over 2 decades while wages lagged. In places like Toronto, the price-to-income ratio hit 4 to 1, echoing Japan's 1990s bubble. Speculation turned housing into a casino, with investors using properties as ATMs for lifestyle spending or more buys. Now the bill comes due. Rising interest rates, triggered by central bank hikes to combat inflation, have exposed the fragility of these over-leveraged positions. Mortgage renewals, peaking in 2026, force borrowers to refinance at rates double or triple their originals. For investors who bought at peak prices, rental income no longer covers costs, leading to forced sales. Power of sale listings reveal the human cost, families losing homes because one member's speculative bets went sour. Stories emerge of teachers, nurses, and small business owners who dipped into real estate thinking it was a sure path to wealth, only to face bankruptcy or massive losses. Pre-construction condos, a favorite of speculators, now appraised below purchase prices, prompting walkaways from deposits and lawsuits. This crash serves as a form of payback for those who fueled the bubble through unchecked speculation. Greedy investors, chasing double-digit annual returns, bid properties into the stratosphere, pricing out first-time buyers and renters. Their actions created artificial scarcity, driving up costs for everyone. Now, as markets correct, these same players bear the brunt. Luxury homes sell at 50% discounts, portfolios crumble under debt, and equity evaporates. The downturn punishes overreach, with speculators' losses rippling through families tied to these risky ventures. Overleveraged households face not just financial ruin but strained relationships, relocations, and shattered retirements. Yet, the impact differs sharply between speculators and ordinary homebuyers. Regular families who purchased modestly for long-term living have more cushion. Their homes, bought without extreme leverage, serve as stable assets rather than gambles. While they may see paper losses, lower prices open doors for upgrades or entry-level buys. First-time buyers, sidelined during the boom, now find opportunities in a buyer's market. Inventory has ballooned to 5.5 months supply nationally, giving leverage to negotiate. In regions like Alberta or the prairies, where speculation was less rampant, prices hold steadier, and sales recover faster. For speculators, though, the pain is acute. Many treated real estate as a get-rich scheme, ignoring warnings from economists about unsustainable growth. Reports from 2022 highlighted risks like RBC's model predicting up to 30% price falls with no growth. Ignored in the euphoria, these forecasts now play out. The crash exposes how greed blinded participants to basics, housing fundamentals tied to incomes, jobs, and demographics. With population growth slowing due to immigration policy shifts, demand softens further. Trade tariffs add uncertainty, keeping buyers on the sidelines. Looking ahead, recovery may take time. CREA predicts a modest 5.1% sales increase to 494,512 units in 2026, driven by pent-up demand in Ontario, and BC prices could edge up 2.8% nationally to $698,881, but larger gains in provinces like Saskatchewan and Quebec contrast with Ontario's expected dips. CMHC warns of subdued demand through 2028, with new construction lagging due to high costs and unsold inventory. Developers pull back, with starts in Toronto hitting 30-year lows. This supply crunch could eventually support prices, but not before more pain. The market's woes trace back to policy lapses that enabled speculation. Loose lending rules, foreign buyer loopholes, now closed, and tax incentives for investors distorted the sector. Calls for tighter regulations went unheeded during the boom, allowing bubbles to form. Now governments scramble with measures like higher stress tests and vacancy taxes, but damage lingers. Economic factors compound the issue. Job losses in tech and finance hit urban centers hard, while tariffs threaten exports. Personal stories illustrate the divide. One Toronto investor, holding 3 condos bought in 2021, now sells at losses to cover renewals. His family relocates amid stress, a direct result of speculative overreach. Contrast this with a young couple who waited out the peak. They buy a starter home at 20% below 2022 prices, building equity steadily. The crash levels the field somewhat, rewarding patience over impulse. Broader effects ripple through the economy. Real estate accounts for a hefty share of Canadian GDP, so slumps drag growth. Household debt, at record highs, heightens default risks. Banks report rising arrears, though still low. If power of sales accelerate, they could depress prices further, creating a vicious cycle. Yet, this correction may restore balance, making housing more accessible long-term. In Vancouver, where investor ownership jumped 50% pre-crash, empty units now flood listings. Prices fell for 0.5% in 2025, with more expected. Similar patterns in Calgary and Edmonton show how regional booms, fueled by oil or migration, unwind when fundamentals shift. Experts urge caution. Sellers must grasp current values, notes one broker, as denial prolongs stagnation. Buyers, with power, pick selectively. For investors nursing losses, lessons abound: diversify, avoid leverage traps, and view homes as necessities, not bets. Canada's real estate saga underscores timeless truths. Markets rise and fall, but speculation amplifies extremes. The current crash, while painful, corrects excesses built on greed. As power of sales mount and sales languish, the sector resets. Families hurt by over-leveraged dreams pay the price, while prudent buyers emerge stronger. Recovery will come, but only after the speculative fever breaks. If you found this video and information useful, please smash the subscribe button and hit the notification bell so we can keep providing you with timely information you can apply on a daily basis.